In this video, we're going to focus on which number should you look at as an investor in these tricky, volatile times with share prices leaping and then plummeting, mainly plummeting recently, of course. How can you be sure that you're buying the right investments, and which number should you be looking at when you do? Now, the directors of a company would like you to focus on profits and the profit and loss account and earnings per share and all those good things as they see it. And I've already made some videos on earnings per share, what it tells you, what it doesn't, and price earnings ratios based on that. There's also one on what is profit. The problem, and I highlight it in those videos, is you can't always trust the profit figure. The profit and loss account comes first when you look at the primary financial statements, profit and loss account, balance sheet, cash flow statement, but you simply cannot always trust the profit figure. Why not? Quick summary, two good reasons why you need to be wary of the profit figure, and then I'll reveal the number that actually right now you ought to be looking at. You don't get for free from the company normally, and that's because the directors would probably, in a lot of cases, rather you ignored it. Okay, more about that number in just a moment. What's wrong with profit? Well, I've done a video on what profit is all about, so I won't labour the point here. I'm not going to run all the way through profit and loss accounts. Please do check out my other videos for that one. However, just bear in mind, profits are based on something called the matching or accruals concept. In a nutshell, what that means is this. In a profit and loss account for 12 months, you capture all of the activity of the business, regardless of whether cash has been received or paid. Very simple example, there are others. Imagine by the 31st of December, my financial year end, I've billed clients £150,000 for work done as a firm. What that means is I can put £150,000 of revenue in my profit and loss account. Okay? However, if I haven't collected any of the cash by the time we hit the year end, the balance sheet date, the cash received is zero. So here's the point, that profit and loss accounts, that's just one difference, capture activity. So on the revenue side, that means if you've done the work and billed for it, sent out the invoice, then you can book the sale. So if you like, it is a trading statement. However, with cash flow statements, you don't recognize any of that revenue until you've actually got a check from your customer. Okay, so there's one fairly fundamental difference. So what I'm suggesting here is there are items in the profit and loss account that are not always cash backed. Why does that matter? Because when it comes to the crunch, cash is king. What are the directors going to pay your dividends with? Ultimately, it's got to be hard cash. What's going to determine whether the company survives or not? Ultimately, hard cash. The other thing, which I'll mention as a separate point, is profits are full of estimates. Now, if you're getting lost at this point, do see my What is Profit video, but I'll give you one very common example. The depreciation, or what Americans like to call the amortization, spell it with a Z for good measure. Basically, this is the way that the directors deal with big capital costs. So you spend £1 million on plant machinery. What do you do with that cost? In a profit and loss account, you decide how long you think that machinery is going to last, 10 years, and you book 1/10 of the cost through 10 years profit and loss accounts, based on the idea it will take 10 years to wear it out before you need to replace it. In cash flow terms, a very different picture. If you spend £1 million on a piece of plant machinery, you book £1 million as an outflow in the cash flow statement. So my point is this, profit and loss accounts are fine, profit as a measure of performance is okay, but in the current climate in particular, you cannot simply trust profit figures. You've got to do some more work. And there is a number which is a vital insight into whether the business is actually managing to back up what it claims in the profit and loss account with hard cash. Okay, so what is that number? Well, it's called free cash flow, sometimes abbreviated to FCF. Free cash flow. Every now and again you'll see it written like that. Now, what is it? It's a cash flow based figure. It's an alternative to a profit number. It's, if you like, a measure of performance based on cash flows, not the kind of subjective estimates that go into building a profit and loss account. And it can be used 2 or 3 ways, which I'll illustrate in just a moment, as a kind of test as to whether the company's reported performance in profit terms is backed up by cash. Now, what is this thing? It comes from something called the cash flow statement. And without turning this video into an academic exercise in what are cash flow statements, basically a cash flow statement is simply a list of the cash that the business has generated from trading, usually known as operating cash flows. This is a very simple summary. So you've got operating cash flows, that's cash received from customers, cash paid to suppliers, and so on. You've got what could loosely be described as financing cash flows. These are the sort of headings that you see, positive or negative. And in there, you've got interest received and paid, and you've got dividends received and paid. So investing activities that generate or use up cash. And then the third heading, investing cash flows, pop it in just there. So your cash flow for the year is the sum of the 3, and these can be positive or negative. This is investment, money applied to buy fixed assets, for example, long-term assets the business is going to carry on using, or even proceeds from the sale of fixed assets. So cash flow statements, buried behind the profit and loss account and the balance sheet, summarise the business's cash flows. Now, that would be the total cash in, or if it's negative, out, over 12 months. So if you like, it's an alternative to the profit and loss account. It tells a story of what the business has been up to for the last 12 months in cash flow terms. How much cash was generated from our operations? How much did we invest or receive from selling the crown jewels, our long-term assets? And how much basically did we receive or pay in terms of interest and dividends? Bracketed together, the sort of financing costs and returns associated with the business, interest on debt and so on. So, where does free cash flow fit in? Well, the answer is free cash flow, unfortunately, is something the directors don't publish normally. If they choose to, it's voluntary, but it's not something that you'll just find thrown at you in the middle of a set of accounts or highlighted conveniently on the cover. So it's something you may have to put together yourself, or if someone else puts it together for you, an analyst, for example, know roughly what they've done. So what are they trying to describe? So free cash flow isn't total cash flow. There's a clue in the name there, it's something else. It represents the cash available to the business as a result of 1 year's trading, if you like, that can be applied by the directors for almost any purpose. It's like their discretionary cash flow. What do I mean by that? It's normally the cash from operations, and you hope that's positive. I mean, crikey, if our day-to-day trading isn't generating cash, then what are we doing? Might as well just shut up shop and do something else. So it's normally the operating cash flow, and then you make 2 or 3 deductions. So you adjust it for interest paid, and the reason for that is you can't not pay interest. You can't say to the bank, we're not paying this year's interest. That's a kind of non-discretionary cash flow. You've got to pay it. And there's an adjustment normally for investment in fixed assets to the extent that it maintains the business. Because again, if you're running a business, you can't choose not to replace fixed assets as they wear out, because otherwise you won't have a business. So there is this concept that free cash flow is effectively the cash available to the directors from their operations after they've paid the stuff they have to pay. Right, an example. MoneyWeek favourite for a while, Reckitt Benckiser, the household goods firm, cleaning products and so on. Let's take a quick look at the 2010 accounts and just ramble through and decide, well, what sort of free cash flow is Reckitt Benckiser generating? Now, you may not want to do this at home every single time on a set of accounts. If you're lucky, you may find the numbers been done for you either by your favourite website. Occasionally these things do pop up on financial websites, or you may find an analyst writes about it. But the point is, as a rough guide to what free cash flow is, let's take a quick look at Reckitt Benckiser, massive firm, well-known name, been around for years, and as I say, they're into the kind of household, domestic, cleaning type day-to-day products that people are supposed to want in the good times and the bad times. After all, in a recession you don't normally stop cleaning your toilet. Okay, so Reckitt Benckiser, let's take a look at a few numbers. 2010 accounts. If I was to rip open the cash flow statement, what I would find is operating cash flow. That's the number I mentioned just now right at the top of, this is all in millions, 2215. Okay, that's all in millions, all right, in sterling millions. That's operating cash flow, that's the cash generated by the business in 1 year. Okay, now what I need to add there is interest. So I mentioned we're going to include some of these cash flows that relate to financing and long-term investing. So you've got interest receivable, 19, that's in millions. You've got interest, so that's on bank deposits and so on, payable of 11 million, so put that in brackets. You've got tax, you can't avoid paying tax, much as though we'd like to, 679 million. This gives you an idea of how this number's put together, and you've got fixed asset purchases. Of 367. And then finally, you've got some sale proceeds from selling fixed assets, so that's purchases, sales, just S for sales, of 42. So that's positive. Now add that lot together. So the operating cash flow, the net interest received in this case, tax paid, can't do anything about that as a board, and fixed asset disposals and acquisitions, and you get down to around 1219 million. Okay, so that would be called the free cash flow, and I'm aware I've travelled quite quickly through that, but these numbers are all available in the 2010 accounts, and that basically gives you a starting point, if you like. So the business generated in 1 year 1219 of free cash flow. Right, how is that useful? Okay, as an investor, that's just a number. How is that useful? Here are 2 or 3 checks that I would reckon I'd want to be doing right now as an investor on a company like Reckitt Benckiser. In other words, don't just trust the profit and loss account, make sure you apply the free cash flow tests. And I would argue there are 2 or 3 good ones that you can do once you know what the free cash flow figure is. Okay, so how am I going to use that number? One option is this. What analysts and investors quite like to do sometimes is, first of all, turn that into free cash flow per share. So what you can do is you can take the annual free cash flow and divide by the average number of shares outstanding. So I'll explain why I'm doing that in just a moment, but here that's 1219, that's in millions again, divided by 724.2. These numbers both from the accounts, and that gives you 168.3p per share. Okay, so free cash flow per share, quite a common way of expressing free cash flow. Now why have I just done that? Because we can now test a number from the profit and loss account that gets a lot more coverage. Earnings per share. Now that is annual earnings from the profit and loss account with all those subjective adjustments and accruals, things, funnies going on in there, divided by this number. So basically we're testing the quality of earnings per share. Now for Reckitt Benckiser, basically if you're looking at the figures for earnings per share, that's the one they do report. You get 216.5p per share. Now that one is available at the front of the accounts as EPS in the profit and loss account, sort of down the bottom. So earnings per share 2.16.5 per share, at free cash flow per share 168.3. So another way of looking at that is roughly 80% of that. Or another way of looking at it is to say, good, here's the reported earnings per share figure. That goes into important things like the price earnings ratio. If you're lost on earnings per share, by the way, do see my separate video on it. There's another video also on price earnings ratio, so that's all out there. So I'm not going to cover that again here. But what we're doing is testing the quality of this number using free cash flow per share. And we're saying, yeah, for 2010, and we could look back over 4 or 5 years to make sure we're being consistent, roughly free cash flow is 80% of earnings per share, broadly speaking. So there is good, or certainly reasonable, cash cover for earnings. What you don't want to see is a massive gap. All right, that's going to start to make you suspicious. If there's a massive gap, so if this is huge and that is small, suddenly you've got to think to yourself, well, the company's reporting great earnings per share, but where's the cash? What's happening? Why the difference? It could be there are some dodgy accounting practices going on in here to boost earnings per share. You need to look at that, investigate it further, satisfy yourself as to what's going on. Or it could be the business is terrible at managing cash. For example, go back to what I said earlier on. Imagine I'm growing a business. I'm billing clients left, right and centre. Okay, and I'm giving them loads of credit. I'm saying, take as long as you like to pay me, just give me your business. All right. What will be happening is I'll be issuing invoices all over the place and booking profits. But where's the cash? Could be taking months to collect. Perhaps I don't even get paid at all in some cases. So I'm apparently growing my business. The profit and loss account is showing sales and earnings. But where's the cash? And that's the key point. So if you get a big gap, it's one of the kind of red flags. It's like an alarm signal. So that's one way you can use free cash flow. Here's another. You can test the dividend. So maybe what we do is we say, okay, is there a way that I can just check in cash flow terms that the business can afford the dividend that it wants to pay? So another way you can use free cash flow is to take free cash flow per share and divide it by dividends per share and express that as a ratio. Now for 2010, that comes out at about 1.6 times. Okay. For anyone not sure about dividends and doing this sort of calculation, again, I do have a separate video out there on dividend yields. Now, what does this tell you? Free cash flow per share divided by dividends per share, what you're looking for is a number of at least 1, and ideally a bit more than that, because, I mean, 2 would be good. What we're saying is, as an investor, dividends are a key part of your return from a business. How many times could the directors have paid that out of annual free cash flow? And you want the answer to be at least once. Otherwise, you've got to start to get seriously worried. So here we're saying, well, yeah, the directors could have paid the current dividend 1.6 times out of annual cash flow. Now, it's a snapshot. It's only 1 year, but it gives you a feel for, in essence, how safe is the annual dividend. All right, so there's another use of free cash flow, a check on the dividend. So we've got a check on the earnings figure. That was the first calculation. We've got a check on the dividend. That's this calculation. And then for bargain hunters, there's another way you can use this. And that's to look at something called the free cash flow yield. You can ask yourself, how cheap is a share? Now, there are other ways you can ask this question. If a business offers a high dividend yield, for example, it might suggest that the share price is relatively low at the moment and you're getting a bargain. So have a look at my video on dividend yields for more on that. There's the price earnings ratio. That's a way of testing whether a share is cheap or expensive. High price earnings ratios, expensive, low PEs, possibly cheap. And again, I have another video on that whole topic. But here is a way of testing it from a cash flow perspective. And in the current climate, I reckon this is a very useful backup measure if nothing else. It's called the free cash flow yield. And what it does, a bit like a dividend yield, except using cash flow, what it tries to do is compare that number I just looked at, the annual free cash flow, which we agreed was 168.3p per share, over the latest share price. Well, it depends which day you look it up, but when I took my reading, that was 3195p. And then it expresses the whole thing as a percentage. That's what turns it into a yield. So 1 year's annual free cash flow over the current share price as a percentage gives you about 5.3%. Now, what we're saying here is, as someone looking for a bargain, what you're looking for is evidence of decent cash flow generation compared to the share price. And actually, this isn't spectacular. Okay, what we're suggesting here is that the cash flow yield, 5.3%, not bad, but that's not screaming bargain at me. It's solid, but it's not screaming bargain at me. And that's partly because Reckitt Benckiser is viewed as a solid defensive stock in times of trouble. So some people have already bought it. But nonetheless, the free cash flow yield is a very useful way of just checking that a share represents good value in cash flow terms. As a value investor, the higher this number, the better in many ways, because it suggests that at the current share price, you're getting annual cash flows relatively cheap. Or put it another way, the yield, the return on your investment, if you buy at today's price in annual cash flow terms, is a good one. So, what are we saying? We're saying there's a number out there which the directors don't publish and that is very useful for investors, especially in the current climate. It's called free cash flow. The problem with it is you have to do a bit of scrabbling around, and not everyone wants to do that, in the accounts to put it together. But you'll also find that analysts refer to it, and occasionally so do journalists. So if you can face bolting the number together, free cash flow, you can then do 3 checks. Number 1, you can test earnings per share. Number 2, you can check whether the company can afford the dividend in cash flow terms. And number 3, you can also use it to eye up a potential bargain. So, as an investing number goes, it's well worth your time.